the different ways of investing. First of all, when we put our money in a bank, that's an indirect way of investing. So when you put your money, for instance, in a savings account or even a high interest-bearing checking account, you're basically letting the bank take that money and put it somewhere else that they'll collect interest from and give you some of that as a share. But that means, of course, we don't have to really think about where we're putting our money or organize it or research or anything like that. We let the bank do all the work. The downside to that is since that's a really safe way of investing money, it means it also doesn't have a good return on it. So that's generally a rule of thumb with investing with any of these types of investments, that the riskier they are, the more reward there is, and the safer they are, the less reward there is. And so people actually invest without even knowing it by putting their money into those kinds of accounts. Also at a bank is a money market account, which works like a checking account, but it has a higher rate of interest because the bank usually has a couple requirements. It usually asks you to put in a lot more cash, so there's a high level threshold. And they also don't let you make more than a certain number of transactions a month. That way they can hold on to more of the money and invest it properly. And the reward for that is you get a little bit higher interest than you would off the other types of accounts. But then if you want to move on to your own types of investing, there's also mutual funds that invest money in bonds, which are some of the safest way of investing. Bonds, particularly through the government, including municipal bonds, are tax-free. So whenever you make money off of them, it can be extremely beneficial. But there's also other types of bonds that we'll talk more about later. And then there's the stock market. And you can either invest in, as it has up here on the screen, common stock or preferred stock. Common stock means that you get to vote in company choices, especially for the board of directors. But it also means you don't get your money as fast. Or you could have preferred stock, which means you give up your right to vote, but you're first in line to get any share of the company's money. And of course, when you get a share of the company's money, that's called dividends. And then there's also real estate investment trusts. And this is so you don't have to go in and buy your own properties or rent houses or things like that. You enter a trust, so that way it buys all kinds of different real estate investments. There, of course, is also a downside because just like anything else, they can make bad property investments and that can fall through and you end up losing your money. So that could be a little bit riskier. But even though it's riskier, real estate is also usually the most profitable because obviously as time goes by, there's 7 billion people now. There will be more people next year and the year after that. So obviously demand for property goes up continually, and so prices are going to go up as well. It's just if you invest in a trust that buys property in a place that's not going to be that profitable. That's the problem. But these are just some of the kinds of investing, and it's important to remember when you invest, the reason why they have all kinds of different investments up here on the screen is because they want you to spread out your money as much as possible because it's always a bad idea to put your money in the same place. It's called diversifying, and it helps us spread out to make sure if one fails, we can always have the others as a backup. That's just a little bit of the basics of investing.